In January 2026, something happened in the gold market that breaks the normal rules people assume still apply. Physically backed gold ETFs pulled in 19 billion US dollars in a single month and added 120 tons of metal. That is not a rounding error. That is a visible reallocation of balance sheets. It pushed total global ETF holdings to 4,145 tons and lifted assets under management to a record $669 billion. Numbers like that don't show up unless big institutions are making deliberate choices. And the strangest part is how fast the mood changed. Not months, not weeks. In 48 hours, the market went from orderly to frantic, the kind of frantic you can measure. Average daily gold market trading volume for the month ran around $623 billion a day. Then, in the final week, daily volume surged to roughly $963 billion a day as volatility spiked. They said this kind of velocity could never happen without a clear emergency headline attached to it. Yet the velocity arrived anyway, not as a rumor, but as a print. Here's what most people miss. When institutions move, they don't announce it. They leave footprints. They leave flow data, positioning data, and dislocations between markets that are supposed to tell the same story. Right now, those signals are contradicting each other in a way that has historically preceded regime shifts. The institutions already know the risks they're hedging. The public usually meets those risks later through price action. What I'm about to reveal isn't opinion. It's the pattern inside the data. Welcome to Channel Name, where we decode what matters before it becomes a headline everyone repeats. If you like analysis that follows the data instead of the drama, consider subscribing the way you'd keep a wise elder close to the table. And tell me in the comments where you're watching from, because the geography of this story is not a detail. It's the signal. Now, let's reconstruct what actually happened with the kind of forensic detail the market deserves. On February 5th, 2026, the World Gold Council released its update showing that January's gold ETF inflows were the strongest on record. The number wasn't just big, it was broad. North America drew in about $7 billion. Asia drew in about $10 billion. Europe added roughly $1.9 billion. Other regions were small by comparison. In other words, this wasn't a local panic trade. It was a coordinated rebalancing across major pools of capital. And within Asia, the distribution was even more telling. Asia represented 51% of net global inflows, despite holding only a fraction of the total gold ETF inventory compared with North America. China alone added about $6 billion. India added about $2.5 billion. That's not a marginal preference shift. That's a rotation you can measure, and it is happening in regions that have their own distinct reasons for valuing physical credibility, not just price momentum. What makes that rotation so important is that it happened while many investors were still treating gold as an afterthought. In portfolio meetings, a 1% shift sounds small, but across trillions, 1% becomes a wave. ETFs are the pipe that turns that decision into reportable demand, and waves reshape shorelines before anyone notices. At the same time, gold prices did something that normally discourages this behavior. The price ended January lower, pulling back late in the month. In a typical playbook, you'd expect inflows to fade when price momentum softens. Instead, inflows arrived anyway. That is a classic signature of allocation demand, not chart chasing. It's the difference between buying because the line is going up and buying because the portfolio mandate changed. If this were the whole story, it would be a simple gold is back narrative. But the real story is the contradiction inside the data. Even as ETF demand and trading activity surged, futures positioning eased. COMEX net long positions fell 6% to about 642 tons in January. Think about what that means. The paper market, where leverage and fast money dominate, was cooling its bullish stance at the very moment the slower, heavier, physically backed ETF channel was absorbing metal. This is where it gets interesting. In quiet periods, paper positioning often leads and ETF flows follow. In stress periods, ETF flows can lead because institutions choose the vehicle that matches their risk constraints. Futures exposure can be reduced while exposure is rebuilt elsewhere. Headlines miss the rotation because they're watching only one screen. To understand why this matters, you have to recognize a pattern that repeats across decades. When gold demand flips from trade to allocation, it often begins with flows that look boring to people who chase price ticks. But those flows change the underlying pressure in the system. Then the system responds, sometimes violently, in ways that make the earlier flows look obvious in hindsight. In 2008, during the financial crisis, gold first sold off as liquidity was demanded, and then it became a refuge as policy responses escalated. In 2011, after years of post-crisis policy and sovereign stress, gold reached new highs as confidence in the stability of the monetary backdrop frayed. In 2020, gold surged again as a global shock forced unprecedented responses and forced investors to confront tail risks that had been priced as near zero. Different years, Different triggers, same underlying mechanism. Once allocation demand takes over, gold stops behaving like a trade and starts behaving like a balance sheet decision. Then there is 2022, when inflation shocked policymakers and real yields, volatility, and currency regimes became the battlefield. That year showed another feature of the playbook. Gold can look stuck while the plumbing underneath is shifting, and then one constraint breaks, and the repricing happens faster than the public narrative can keep up. The exact dates differ. The sequence is consistent. Now bring that framework to today. The year 2025, just completed, saw global gold demand cross 5,000 tons for the first time on record at 5,002 tons. Investment demand surged 84% to 2,175 tons. Central bank purchases slowed compared with the prior year, but still came in around 863 tons, which is not a small number. What changed was who the marginal buyer was at the margin and what vehicle they used to express that demand. ETFs matter because they are the bridge between institutional portfolios and physical metal. When a physically backed ETF adds metal, it is not a promise. It is an inventory change. Bars are allocated. The mechanics of the market become physical. The balance of available supply shifts. That is why ETF flows can be a cleaner signal than a futures position that can be unwound in an hour. So who is moving specifically? Start with the regions. North America's roughly $7 billion of inflows tells you large pools of capital we're allocating, pensions, endowments, advisors, and the institutional platforms that service them. Europe's inflows tell you the story isn't confined to one macro narrative. But Asia's $10 billion and its 51% share of global inflows is the center of gravity. China's $6 billion stands out. India's $2.5 billion stands out. Those numbers point to a demand source with its own rhythm, its own policy environment, and its own preference for tangible credibility. Then look at trading behavior. Gold ETF trading activity rose to about $23 billion a day in January, up 160% from the prior month. That kind of jump means institutions were not only buying and holding, they were repositioning. They were using these products actively, treating them as liquid instruments during a period when volatility was rising and when speed mattered. And volatility did rise. Average daily gold market trading volume hit about $623 billion a day in January, 52% higher than the prior month, and well above the average pace of 2025. Then, in the final week, the market printed roughly $963 billion a day in daily volume. High volume is not just excitement, it is stress, it is urgency, it is forced behavior mixed with decisive behavior, and you can hear it in the tape if you know what to listen for. Now comes the dislocation. Two markets are telling opposite stories. The physically backed ETF channel is showing allocation demand. The futures positioning is easing. If you only watch futures, you might conclude demand is fading. If you only watch ETFs, you might conclude demand is accelerating. Both can be true at the same time, and when they are, it often means the market is transitioning from one regime to another. Why would paper positioning cool while physical vehicles accumulate? Because leverage is a liability when volatility rises. Because risk managers tighten limits. Because volatility targeting systems reduce exposure mechanically. Because margin sensitivity becomes a decision factor. Because exposure can be re-expressed through vehicles that fit the rules of different balance sheets. That is not a plot. That is portfolio plumbing. Imagine a highway where sports cars and cargo trucks share the same lanes. Futures are the sports cars, fast, leveraged, and sensitive to sharp turns. Physically backed ETFs are the cargo trucks, heavier, slower, and designed to carry inventory. When the road gets slick, the sports cars slow down or exit. The cargo trucks keep moving because they're delivering a load that was scheduled and approved. Watching only one lane gives you the wrong picture of traffic. Now, connect the dots among the players. The headline name is Gold ETFs, but the real actors are the institutions behind those flows. Pension committees that rebalance at month end, sovereign wealth portfolios that respond to changes in risk assumptions, insurance balance sheets that prefer liquid, collateral-friendly exposures, asset allocators running risk parity strategies who adjust hedges when volatility regimes shift, multi-asset funds that decide a small allocation change is worth more than a complex stack of derivatives because it behaves cleaner under stress. At the same time, the derivative ecosystem is adjusting. When futures net long positions fall to roughly 642 tons, that reflects the reduction of speculative net length. It can be driven by hedge funds reducing exposure, by dealers hedging differently, and by the simple math of volatility. Higher volatility increases value at risk, which reduces allowable position sizes under many risk frameworks. So paper length comes down even if the longer-term allocation rises. Now, why call this a crisis at all? Because dislocations are pressure points, and the gold market is a market where the difference between paper claims and physical settlement reality matters. ETFs are physically backed, They don't solve every constraint, but they are closer to physical reality than many derivatives. When ETF holdings rise to over 4,145 tons, that is a visible claim on available vaulted metal. If you've watched supply chains in other markets, you know what happens when inventory is drawn into fewer hands. Prices can remain calm for a while until a particular moment when availability becomes the story. Gold is not consumed like oil. It is stored, but storage is not evenly distributed. The location, the bar list, the chain of custody, and the willingness to lease or mobilize metal all matter. So do local liquidity conditions and the rules around how investors are allowed to hold exposures. And this is where the East-West dimension becomes more than a narrative. It is a shift in where incremental claims on physical inventory are concentrated. When China adds $6 billion and India adds $2.5 billion, that reflects domestic demand for products embedded in local financial systems. The metal may be vaulted in different places, but the economic claim and the behavioral stickiness shift. Over time, shifts like that change how quickly metal can be mobilized and which holders are likely to part with it when stress rises. Now, let's talk about dislocations in history and what followed, because this is not the first time two signals diverged. In 2007 and 2008, futures markets and physical demand sent mixed messages as liquidity needs distorted price action. The result was that gold's role as hedge and collateral became more valuable after the initial stress. In 2011, investor demand surged even as some speculative measures looked stretched, and the result was a sharp peak that coincided with changing policy expectations. In 2020, dislocations appeared between liquidity needs and safety demand, and the result was that gold's role as portfolio ballast reasserted itself quickly once the forced selling phase passed. The lesson is not that one market is right and the other is wrong. The lesson is that when they diverge, the market is transmitting information about constraints. Futures can be a temperature gauge of fast money. ETFs can be a record of allocation. When temperature cools but inventory demand rises, the system is changing its structure. So what mechanism could be driving January 2026's measurable rotation? Start with volatility. When volatility rises, many strategies mechanically reduce exposure to equities and credit. That can free capital that then needs a home. Gold, in certain stress regimes, becomes a candidate because it behaves differently from traditional risk assets. At the same time, if currency volatility rises or confidence in the path of real yield shifts, gold's role as a hedge becomes more attractive. The decision is often made quietly in a risk meeting. A small percentage change that sounds conservative but becomes enormous when executed across large pools of capital. Now, layer in the calendar. January is a month of new allocations, new year, new mandates, new risk budgets. If a committee decides to raise a strategic allocation to gold, execution often happens early through liquid ETFs. That is why record inflows in January are so informative. They suggest the change was planned, not improvised. Next, consider the late month price pullback. If inflows continue, even as price softens, that indicates buyers are less sensitive to short-term performance. That is allocation behavior. It also implies the bid under the market is structural, not speculative, which can change the character of sell-offs. Dips become inventory opportunities rather than reasons to abandon a thesis. Then consider the drop in COMEX net longs. That can reflect a reduction in leveraged positioning because of risk controls, not a collapse in belief. If the same macro thesis is expressed through ETFs rather than futures, the net effect is a shift from leveraged exposure to unleveraged, physically backed exposure. That changes the market's elasticity. It can reduce the kind of squeezes that come from crowded leverage, but it can also tighten physical availability over time, which matters when the world tries to hedge the same risks all at once. Here's the part few people talk about. The scale of trading volume suggests not just buying, but conflict. When daily gold trading reaches 623 billion and then almost 1 trillion, it means someone is selling what someone else insists on buying. And when the month ends with a pullback, it means sellers were able to push price down despite record inflows. That tension is exactly what creates a setup. Because if buyers are structural and sellers are tactical, tactical selling can run out of ammunition while structural demand keeps showing up. Think of it like a sponge and a faucet. The ETF inflows are the sponge absorbing steadily. The futures market is the faucet turning on and off, sometimes blasting, sometimes dripping. In January, the sponge got much bigger while the faucet turned down. If the faucet turns back on while the sponge remains large, the plumbing can get stressed because liquidity that felt abundant can feel scarce when everyone wants the same hedge at once. Now, let's make the evidence concrete, because this must be about numbers. $19 billion of inflows in 1 month, 120 tons of gold added, holdings at 4,145 tons, assets under management at 669 billion, Asia at 51% of inflows, China at 6 billion, India at 2.5, ETF trading around $23 billion per day, market trading volume around $623 billion per day, then roughly $963 billion per day in the final week. And COMEX net longs down 6% to about 642 tons. One more contradiction sits inside those numbers. Assets under management hit a record even though the price ended the month lower. That means the record was not simply a valuation effect. It was flow. It was participation. It was size. And that's why this is measurable rotation, not a story someone can talk away. Now ask what it means going forward, not as a prediction, but as a conditional pattern. Historically, when physically backed vehicles absorb metal at this pace, one of three things tends to happen. In a conservative scenario, the flows slow after the initial allocation, volatility calms, and the market digests the inventory change without a dramatic repricing. In that case, the key is whether holdings stay elevated. If holdings remain near 4,145 tons, it signals the allocation was sticky and that the metal is effectively off the market for a while. In a moderate scenario, flows remain positive but not record-breaking, while futures positioning rebuilds as volatility subsides. That closes the dislocation. Price can grind higher or become more resilient to sell-offs because structural demand absorbs dips. In that case, watch for futures net long positions turning higher while ETF holdings continue to hold firm or climb. That combination is often when price behavior changes from fragile to supported. In an aggressive scenario, the dislocation persists and then snaps. That can happen if volatility spikes again, if currency stress rises, or if some external shock forces more allocation into gold while the physical market tightens. In that case, the market's reaction can be nonlinear. It can move in days, not quarters, because liquidity is thinner than people assume when everyone wants the same hedge at once, and because risk systems reprice simultaneously. Notice what is absent from these scenarios. There is no guarantee. There is no single forecast. There is only the logic of constraints and the history of how markets behave when the same pattern repeats. So what should be watched if you want to see the next phase before it becomes obvious? Watch whether ETF holdings continue to rise after the record month. Watch whether inflows broaden further in Asia or rotate back toward North America and Europe. Watch whether trading volume remains elevated because persistent high volume signals persistent stress. Watch whether futures positioning starts to rise again because that would indicate fast money is re-engaging. And watch whether price becomes less responsive to bad days because that is often the first sign that structural buyers are absorbing what used to create fear. Also, watch for the subtle signals that show up before the big ones. Tightness tends to appear first as friction. Wider spreads, higher urgency in hedging, and more sensitivity to delivery windows. You don't need a dramatic headline to see that kind of stress. You only need to notice when normal behavior stops being normal. The deeper point is the divide. Some people watch price and think they understand the market. Others watch flows and understand why price moved. It's not about being smarter, it's about paying attention to what can't be faked easily. Flow data is hard to argue with. Holdings either rose or they didn't. Tonnage either moved or it didn't. Assets under management either hit a record or it didn't. Volume either surged or it didn't. Institutions move first. They always do. They move through mechanisms designed to be quiet, compliant, and scalable. Retail moves last, guided by headlines that explain yesterday's price action with today's story. That information gap becomes a wealth gap, not because anyone is better, but because the market rewards those who see the shift while it is still visible in the footprints. If January 2026 is the start of a sustained allocation phase, the evidence will keep printing. If it was a one-off, the flows will fade and holdings will drift. Either way, the method remains the same. Track the measurable rotation, track the dislocation, and refuse to be distracted by narratives that don't match the numbers. This is Channel Name, where we decode what matters before it becomes the headline everyone repeats. If this connected dots you hadn't seen, you know what to do. The question isn't whether markets keep changing. The question is whether you recognize the change, while it's still measurable, while the footprints are still fresh, and while the crowd is still looking in the wrong direction.